Silver just ripped to $117 an ounce. Not 110, not 100. An all-time high that shattered decades of resistance and left most traders scrambling to figure out what just happened. But here is what you need to understand. The move was not random. The signals were there. Most people miss them because they were watching price instead of watching structure. If you are stacking silver, if you are trading metals, if you have been sitting on the sidelines waiting for confirmation, this is your wake-up call. Not because I am telling you what to buy, I am showing you what to watch. The mechanics underneath this move have been building for weeks. And if you understand those mechanics, you are ahead of 90% of the market right now. Your job is not to predict the next tick. Your job is to read the pressure before it blows. Hit subscribe right now if you want to stay ahead of these moves. Comment ATH Watcher if you are tracking this with us. We are building a tribe that does not chase headlines. We watch structure. So let me give you the setup. Silver rallied from the low 80s to 117 in a matter of weeks. Gold also surged, crossing 3,200, but silver led. That tells you something. The mainstream narrative will focus on safe haven flows, dollar weakness, geopolitical uncertainty. All true. But surface level, what most commentators will not talk about is what happened underneath. Retail premiums started widening weeks ago. Dealers could not keep inventory moving fast enough. Physical spreads over spot tightened. Lease rates started firming. COMEX warehouse registered inventories began draining. These are not headline signals. These are the quiet mechanics that matter before the price explodes. You will never see this pressure if you only watch the chart. Price is the output. Structure is the input. And right now, structure is screaming, not telling you to buy or sell, showing you what the informed players were watching while everyone else was debating whether silver would ever break 100. Let me explain the first mechanism. I call it the pressure valve pattern. Think of it this way. Price is the broad pipe. Everyone watches it. It moves visibly. But physical flows and premiums are the narrow pipe. Most people ignore it because it is not flashy. When the narrow pipe tightens beneath unremarkable price action, pressure builds without loud signals. Then it breaks. Hard. Imagine a steam kettle. Water boils quietly at first. Pressure rises inside. The valve holds. No one notices. Then the valve releases and steam explodes out. That is what happened with silver. Weeks ago, premiums started rising. Dealers were paying more to secure physical inventory. Retail buyers faced longer wait times. Spreads between spot and delivered metal widened from $2 to $5, then $7. Meanwhile, spot price was grinding sideways in the mid-80s. Nothing exciting on the chart. But underneath, the narrow pipe was choking. This pattern repeats across metals, commodities, and currencies. It shows up every time physical demand tightens faster than paper markets can reflect. The paper market is liquid, massive, easy to trade, but it does not move metal. The physical market moves metal. When physical tightens, paper eventually has to catch up. That catch-up is violent. Circle this. When you see premiums rising while price consolidates, you are watching the valve tighten. When you see warehouse stocks draining while open interest stays flat, pressure is building. When lease rates start ticking up from near 0 to 20 basis points, then 40, the narrow pipe is clogging. Most traders wait for the price breakout to confirm the move. By then, the informed player's already positioned, not predicting timing here, showing structure. The silver move to 117 was not a surprise if you were watching the narrow pipe. It was loud to anyone tracking physical flows, silent to everyone watching CNBC. Your job is not to catch every move. Your job is to recognize the setup, so you are not caught flat-footed when the valve blows. This mechanism does not care about your opinion. It does not care about targets or hopium. It cares about supply, demand, and the physics of tight markets. And right now, those physics are still in play. Now let me show you the second mechanism, the liquidity trap sequence. This one is brutal. It separates disciplined participants from emotional ones. Here is how it works. Momentum attracts late speculators, always. When silver cracked 100, retail piled in. When it hit 110, more rushed in. By the time it spiked to 117, the crowd was euphoric. Headlines screamed. Social media exploded. Everyone wanted in. That is exactly when the trap snaps. Big moves attract liquidity, but that liquidity is not evenly distributed. It floods in fast, chasing price. Then, it evaporates just as fast when volatility spikes. Around the 117 high, silver whipsawed violently. It spiked, pulled back $15 intraday, then recovered, then dropped again. Classic liquidity trap behavior. Paper markets went chaotic. Futures traders got stopped out. Leveraged longs got squeezed. Weak hands panicked and sold into the dip. Meanwhile, informed participants who understood the structure used the volatility to add positions or lock gains. Imagine you were standing in a crowded theater. Someone yells fire. Everyone rushes the exits at once. The exits are narrow. Chaos. Panic. People get trampled. That is what happens in momentum-driven markets when the crowd all tries to move at the same time. The liquidity that seemed infinite on the way up disappears on the way down. Bids vanish. Spreads widen. Slippage destroys accounts. This is not a bug. This is the feature. Late momentum creates fragile positioning. When volatility spikes, fragility breaks. Think about that. The same energy that drove silver to 117 is the same energy that will shake out the unprepared. Not advice, pattern recognition. If you entered late without understanding structure, you are vulnerable to whipsaws. If you entered early watching the narrow pipe signals, you have context and can ride the chaos. Your edge is not speed, your edge is structure. The liquidity trap sequence punishes belief without discipline. It rewards preparation. And here is the kicker. This sequence does not mean the move is over. It means the market is sorting participants, shaking out weak hands, resetting positioning. Often the strongest moves come after the first violent shake, because that is when the crowd exits and the structure reasserts. We have seen this in gold in 2020. We have seen it in crude during supply squeezes. We have seen it in every major commodity breakout over the last 2 decades. The trap is part of the process, not the end of the process. Could silver reverse from here and collapse? Yes. Could it consolidate and rip higher? Also yes. Your job is not to know which. Your job is to watch the signals that tell you which scenario is unfolding in real time. Here is what you need to sit with. Everyone is asking the same question right now. Is silver going to 200? Is it going back to 90? Should I buy the dip or sell the rip? Wrong questions. The real question is this. Are the structural signals that drove this move still tightening, or are they starting to ease? Because price will follow structure, always. If premiums stay elevated, if warehouse inventories keep draining, if lease rates keep climbing, the pressure valve is still building. That sets up another leg. If premiums collapse, if inventories stabilize, if lease rates roll over, the move is exhausting. That sets up a correction. You cannot know timing, you can only watch structure. And that is exactly what we are going to equip you with next. The exact signals to track this week and next. Not theory, not hopium, real-time indicators that separate speculation from setup. Stay with me. Let me lay out 3 plausible paths forward, not predictions. Frameworks. Path 1. Continuation. Physical tightness persists. Macro drivers stay supportive. Dollar stays weak. Geopolitical uncertainty escalates. Silver consolidates briefly in the 100 to 110 range, then breaks higher toward 130, 140, maybe beyond. Who wins? Early positioned holders, disciplined traders who add on pullbacks. Who loses? Late chasers who panic on dips. Leverage longs without risk management. What to watch? Premiums staying firm, warehouse stocks continuing to drain, lease rates climbing higher. Path 2. Correction and retest. Volatility shakes out momentum traders. Profit-taking accelerates. Silver pulls back to the low 90s or high 80s. Structure remains intact underneath. Physical demand does not collapse. Premiums ease slightly but do not crater. This sets up the next breakout in weeks or months. Who wins? Patient accumulators, those who understand retest dynamics. Who loses? Panic sellers, those who confuse volatility with structural failure. What to watch? Premiums easing but not collapsing. Inventories stabilizing but not surging. Lease rates holding above baseline. Path 3. Consolidation. Price cools and trades sideways between 100 and 115 for an extended period. Headline excitement fades, but underneath, The narrow pipe keeps tightening. Premiums stay elevated. Warehouse stocks grind lower. Lease rates tick higher slowly. This is the stealth setup. Pressure builds again without fanfare. Who wins? Those who stay patient and keep watching structure, not price. Who loses? Impatient traders who exit during the boring phase. What to watch? Divergence between flat price and tightening physical signals. No one knows which path unfolds, but the signals will tell you in real time. Here is what I am tracking this week and next. Signal 1, retail premium spreads versus spot. Normal behavior. Premiums run $1 to $3 over spot in balanced markets. Stress behavior. Premiums widen to $5, $7, $10 or more. What it means? Rising premiums while price consolidates or dips signal continued physical demand pressure. Falling premiums signal easing demand or increased supply. Check dealer sites daily. Compare American Eagles, Maples, generic rounds. Watch the trend, not the number. Signal 2. Warehouse inventory flows. Specifically, registered COMEX inventories. Normal behavior. Stable or slowly declining inventories with occasional inflows. Stress behavior, sharp, sustained drawdowns in registered stocks. What it means? Registered inventory is what backs futures delivery. When it drains, the paper market gets fragile. If registered stocks drop below critical thresholds, delivery risk rises and price pressure builds. Track the weekly COMEX reports. Watch for accelerating outflows. Signal 3, lease rates. 1-month and 3-month silver lease rates. Normal behavior, near zero or slightly negative in calm markets. Stress behavior, rising into positive territory, especially above 20 to 50 basis points. What it means? Lease rates reflect the cost to borrow physical metal. When they rise, it signals real demand for physical delivery and tightening availability. This is a forward-looking indicator. It moves before price does. Check Bloomberg or Bullion Bank data if you have access. Even directional moves matter. Signal 4. Gold to silver ratio behavior. Watch how silver performs relative to gold at key zones. Normal behavior. Ratio oscillates in a range. Silver lags gold. Stress behavior. Ratio contracts sharply. Silver outperforms gold. What it means? When silver leads, it signals speculative interest and industrial demand converging. When the ratio expands again, silver is losing momentum. Right now, the ratio compressed from 90 to around 27. Watch whether it holds or reverses. Signal 5. Open interest and positioning shifts. Track COMEX futures. Open interest and commitments of traders' data. Normal behavior, balanced positioning. Commercials net short. Speculators net long. Stress behavior, commercials covering shorts aggressively. Open interest surging or collapsing. What it means? When commercials cover shorts quietly, they are repositioning for higher prices. When open interest explodes with price, late speculators are piling in and risk is rising. This data lags by a few days, but the trends matter. For each signal, normal tells you the structure is balanced. Stress tells you pressure is building or breaking. Your job is to track multiple signals together, not one in isolation. When 3 or 4 flash stress at the same time, pay attention. When they ease together, respect the shift. If you are holding, accept pullbacks as part of the process. If you are trading, respect volatility and use stops. Do not chase peaks. Do not panic on dips. Stay disciplined. Keep position sizes manageable. Understand what you own and why. Could reverse tomorrow. Could rip higher next week. Structure does not guarantee direction. It shows you the setup. If you track these signals, you are not reacting to headlines. You are reading structure. You are watching the narrow pipe while everyone else watches the broad pipe. You are in the group that does not get shaken out by volatility because you understand what is happening underneath. That is your edge. Not speed, not luck. Structure. Silver at 117 was not the end of this story. It was the wake-up call. The question now is whether you are paying attention to the right signals or just watching the price ticker. Comment below which signal you are watching most closely this week. Premiums, inventories, lease rates, the ratio, or positioning. Tell me what you are seeing. Hit subscribe if you want to stay ahead of the next move. We are not chasing headlines here. We are building a tribe that understands mechanics. And here's the final insight. Most traders will look back at this moment 6 months from now and wish they understood what was happening. You are here now. You have the framework. You have the signals. Your job is to stay disciplined and keep watching, not telling you what to do, showing you what to watch. The rest is up to you.